Success in trading is not about hitting home runs, it's about consistent base hits. Every trader dreams of big wins. Seeing a 1.3 risk-reward trade seems like the golden ticket. Risk a little, gain a lot. It feels exciting, glamorous, and tempting. But here's the truth. Chasing massive gains doesn't always create consistent profits. That's why many professional traders find more success with one risk-reward trades. The psychology behind one risk-reward is simple. When you risk 1 unit to gain 1 unit, the trade feels achievable and the results are predictable. Wins and losses are closer together, and your mental stress is lower. You don't feel like every trade must become a huge victory. This allows you to stick to your strategy without overthinking or taking excessive risks. Contrast this with 1.3 risk-reward trades. The math may look appealing. You risk 1 to gain 3, but the reality is harsh. You may need a higher winning percentage just to stay profitable. Missing a single trade can feel devastating because you are mentally tied to the idea of hitting a big win. The pressure builds, mistakes creep in, and consistency fades. Consistency comes from small, repeatable actions. A 1-to-1 RR trade offers this. Even if you have a string of small losses, the mental impact is manageable. You can continue executing your strategy calmly. Your confidence doesn't crumble after one missed opportunity because the stakes per trade are aligned with what is realistic, not with fantasy expectations. Another factor is execution ease. 1.1 trades allow you to follow rules strictly. Entry, stop loss, and target levels are simpler to manage. There's less temptation to move your stop or target because you are chasing a bigger reward. Rules adherence becomes easier, and discipline naturally improves. Emotions play a huge role in trading consistency. High RR trades amplify fear and greed. Every trade carries a mental weight 3 times bigger than the risk. You may hesitate to enter, second-guess your strategy, or exit too early to protect gains. Over time, this emotional stress reduces overall performance, even if the math seems favorable. On the other hand, 1.1 RR trades keep emotions in check. Wins feel satisfying, and losses are digestible. The mind remains balanced, allowing rational decisions. Consistency grows because your strategy is followed reliably, trade after trade. Even top traders often prioritize consistency over large payouts. Big profits are tempting but repeatable. Small wins build equity steadily. In markets, compounding small, consistent gains is more powerful than occasional huge wins that risk large losses. It's not the size of the win, but the consistency of execution that defines success. Imagine 2 traders. Trader A uses 1.1 risk-reward trades. Trader B uses 1.3 risk-reward trades. Both start with the same strategy, the same capital, and the same market conditions. Trader A executes 5 trades in a day, winning 3 and losing 2. Each win and loss is small but predictable. Mental stress is low. Trader A moves to the next trade calmly, following the rules with confidence. Trader B executes 3 trades, aiming for a 1.3 reward each time. They win 1 and lose 2. On paper, the win seems big, but the losses feel heavier. Emotion kicks in. Fear of another big loss makes Trader B hesitate on the next trade. They second-guess entries, exit early, or skip trades entirely. The stress accumulates and strategy execution suffers. High RR trades often require more precision. If your analysis is slightly off, the trade fails. This raises the risk of missed opportunities or mistakes. 1.3 trades need higher winning accuracy to be profitable. Traders may chase setups to make up for losses or hesitate to enter because perfection feels necessary. Both scenarios reduce consistency. Another scenario is the stop-loss temptation. High RR traders often feel pressure to let a trade run longer to hit the big target. This can lead to moving stops, risking more than planned, or holding on to losing trades. 1.1 R traders rarely face this temptation. The target is achievable, and losses are controlled. Psychology is key. High RR trades exaggerate fear and greed. After a loss, a trader may feel compelled to win it back with a larger position. This can lead to revenge trading or impulsive decisions. 1.1 RR traders experience smaller emotional swings, allowing them to stay disciplined. Even in trending markets, 1.1 RR traders tend to compound gains steadily. Small, repeatable wins accumulate over time. The math may seem less exciting than occasional big wins, but the result is smoother equity growth. High RR traders may have wild swings in their account, creating inconsistency and stress. Consistency also improves risk management. When losses are small, traders can take more trades safely, recovering from losses without emotional overload. High RR trades can amplify losses, forcing traders to reduce trade frequency or deviate from their plan, which reduces consistency further. Ultimately, real trading shows that small, predictable profits beat occasional big wins when it comes to long-term consistency. Markets are unpredictable, and aiming for huge rewards every time exposes you to unnecessary risk and emotional pressure. 1.1. RR trades balance risk and reward, keeping your strategy executable and your psychology intact. Discipline beats desire when it comes to long-term trading success. Consistency in trading isn't just about numbers, it's about how your mind reacts to the market. 1.1 RR traders enjoy emotional and behavioral advantages that high RR traders often struggle to maintain. First, 1.1's RR trades reduce stress and fear. When your potential loss matches your potential gain, every trade feels manageable. You don't enter the trade feeling like your financial future depends on it. Losses are digestible, and wins feel motivating without being overwhelming. This emotional balance allows you to stick to your plan and maintain consistent execution. High RR trades, on the other hand, amplify fear and greed. A 1.3 RR trade makes every loss feel significant and every win feel urgent. The emotional stakes are higher, leading to hesitation, overtrading, or moving stop losses to protect gains. Over time, this emotional pressure erodes discipline, reducing consistency. Second, 1.1 RR traders follow rules more easily. When the target and stop loss are realistic, it's easier to respect them. There's less temptation to deviate. Behavioral biases like overconfidence, impatience, and revenge trading are minimized. When every trade feels achievable, sticking to your plan becomes natural. Third, 1.1 RR trading encourages habit formation. Small, repeatable wins reinforce confidence and reinforce disciplined behavior. Traders build a routine, plan the trade, execute the trade, review the outcome. Each completed cycle strengthens consistency and improves long-term performance. High RR trades often break this habit loop. A single big loss or missed opportunity can disrupt routine, trigger emotional trading, and reduce the ability to execute systematically. The bigger the target, the higher the pressure, and the more likely behavior drifts from the plan. Fourth, 1.1 RR traders cope better with losing streaks. Losing 2 or 3 trades in a row at 101 is a setback, but it's manageable. Emotional resilience stays intact, allowing traders to continue without panic. High RR trades make the same streak feel devastating. The larger swings amplify stress, often leading to impulsive recovery attempts that hurt consistency even more. Finally, 1.1 RR trading supports long-term focus over short-term excitement. The goal becomes steady progress, not chasing big wins. This shift in mindset encourages patience, realistic expectations, and disciplined execution, all key ingredients for consistent trading performance. By combining manageable risk, achievable targets, and emotional balance, 1.1 RR traders create a system where psychology supports the math. They are calmer, more disciplined, and more consistent, even if individual trade profits are smaller. Over time, these advantages compound, leading to smoother account growth and long-term success. Small, steady steps win the trading marathon. Now that we've explored the psychology, real-life scenarios, math, and behavioral advantages, it's clear why 1.1 risk-reward trades lead to more consistent results than 1.3 trades. Consistency isn't about the size of each win. It's about executing your strategy reliably, managing emotions, and compounding results over time. The first lesson is that manageable risk reduces emotional strain. 1.1 RR trades keep losses digestible, making it easier to stick to your plan. When fear and greed are minimized, discipline naturally improves, and strategy adherence becomes second nature. Second, achievable targets foster confidence in habit formation. Repeating small wins reinforces the behavior loop: plan, execute, review. High RR trades often disrupt this cycle because larger targets are harder to hit consistently, which increases emotional pressure and reduces focus. Third, mathematics favors consistency over occasional big wins. While 1.3 RR trades promise larger gains per trade, they require a higher level of precision and often expose traders to larger account swings. 1.1 RR trades offer predictable outcomes, tighter variance, and better probability alignment, which builds trust in the system and mental resilience. Fourth, behavioral advantages matter more than the numbers alone. Traders who stick to 1.1 RR trades cope better with losing streaks, avoid impulsive decisions, and maintain long-term focus. Emotional stability allows for repeated execution, which is what separates consistent traders from inconsistent ones. Finally, long-term success is about compounding discipline, not chasing big wins. Each small, controlled trade adds to your equity, grows confidence, and strengthens your ability to stick to rules. Over time, this consistency outperforms the occasional high-risk trade that creates volatility, stress, and mistakes. If you're serious about trading success, focus on consistency first, then growth. Embrace achievable targets, manage risk, follow your plan, and keep emotions in check. By prioritizing discipline and steady execution over chasing large rewards, you'll maximize your chances of long-term profitability. If you found this video helpful, like, subscribe, and hit the notification bell for more trading psychology and strategy insights. Share your experiences in the comments. How has risk-reward affected your trading consistency? Join a community of traders committed to smart, disciplined, and consistent trading. Discipline, patience, and consistency. These are the true keys to trading success.